off about 2.3%, 492 points. Russell 2000's down 3%. So you've got a real sell-off happening here.
And it follows 2 days of sell-offs as well as the third day of market sell-off now. Obviously, the last two were pretty minor.
I was attempting to get there.
Sorry.
But I appreciate you.
I wanted to get in.
I appreciate you taking us there. This is really the first instance of this that we've seen. You could say towards, mid to late May, we kind of saw a little something heading into Labor Day, but it wasn't like this. It didn't have this tenor to it, especially given that the last week and a half, under the hood, you've seen some kind of troubling signs in a few different areas that have now kind of, bubbled up into the parts of the market that have been carrying it forward. So it's not to say like this is going to be a redux of April. I don't think we're heading back to, the VIX at 50. I don't think we're heading for, a 20% drop in the span of 3 weeks. But I do think this is the first real sense that I get that there might be some selling pressure out there just in the short term. And look, this is part of doing business in markets, and it's something that happens from time to time. And ultimately, we'll see where it goes. Like, who knows what happens over the next few days? We could be sitting here on Wednesday being like, gee, that was fun. We're right back to where we were before. But
yeah. And, we've talked about this being the busiest week of the year, and so there's a few different factors that seem to be moving markets this first day of August. Speaking of markets, you've also got yields moving dramatically. The 10-year yield moving down more than 10 basis points, down to 4.236% this morning.
Yeah, so in terms of the proximate cause of what we're seeing in markets, look, we've got a lot to get through. When I came on today, Tucker was like, "Hey, we could do a 4-hour show today," and it's true. There's a ton. So if you hear me talking quickly, it's just because I have a lot that I want to get through, and it's like there's a lot of meat here. But proximate cause of this is. So you look at kind of how things progressed last night, and I always do this because I'm a loser, I'm always, from 8 to 10 just kind of watching how futures are trading, and then quite honestly, I usually wake up and have to go to the bathroom somewhere around 4 a.m., and so I check how futures are trading then, and then I finally wake up for good around 5, and I'm like, okay, like, how are they? It's just like when you're in this, and so what's interesting to me is I went to bed, and futures were off modestly after the Trump tariff announcement, where, in case you didn't see, or in case we haven't covered it yet, but new set of tariffs on about 60 countries, looks very similar to the April 2nd, the Liberation Day tariffs. Some differences, obviously some lower. The only one that I found that was higher, Mike, was Switzerland, which for some reason went from a 31% tariff to 39%. I don't know what the Swiss did over the summer, but apparently the answer is not enough. But in any case, these are going to be going into effect next Friday, so a 1-week delay, same as we saw in the spring. There was a comment from Scott Bessent yesterday, or maybe it was the day before, which was along the lines of, hey, if these are in place for a few days or a few weeks, it's not going to be a big deal, which to me is almost a sign like, hey, they're going to capitulate on these also. I don't know if you saw that quote.
I did not.
So that was kind of interesting to me. It's almost like, are they pre-selling that these aren't going to be kept in place for very long? I don't know, but I saw that comment from Besson, and I was like, what does that mean? So that was kind of notable. But ultimately, I went to bed, and futures were off 0.25% or so. By the time it was 4 a.m., I'm like, futures are down 1%. Like, something's happening here. And there are a couple different ways to look at this. The first is, hey, maybe it just had to be digested overnight a little bit. The second is, hey, we saw something interesting yesterday, which was semiconductors getting whacked even worse than the broad market. And if you've watched semiconductors over the last few months, as I have, they've been the leader in the clubhouse. Where semis went, the market went. And so semis getting whacked yesterday, I kind of looked at it and I go, you just got these big CapEx guides from, all of the AI guys. And semis are getting, bopped on the head like Bunny Foo-Foo's just, running around, hitting all the field mice. Like, what gives? And so maybe it's just that market leadership starting to roll over. On top of that, and we'll get to this, you had an earnings report from Amazon that was good for the quarter, but the guidance was, quite honestly, pretty bad. And so it's just kind of this convergence of factors, and it's kind of taken all week because we talked about, hey, like this is one of the busiest weeks with so much important data could really move markets. And through midday yesterday, the S&P had moved a total of 2 points over the week. And so it was kind of like, okay, what gives? Like, you've had all this data and the market can't figure out where to go. And then basically since noon yesterday, it's been a unidirectional market, and that direction has been down.
I've got a technical fact to just kind of debate with you here, Chuck, which is I don't think that you looking at futures at 11 p.m. and then again at 4 a.m. makes you a loser. If you were unemployed,
I do that every night.
But if you were unemployed and living in your mom's basement and doing that, then I think, yeah, loser status applies. But you do have a job. This makes you more of a nerd than a loser, and I think we need to differentiate between those two.
I'm a newser.
Okay, fair enough.
See, that's like a double entendre.
Yeah.
Anyways, so let's actually dig into some of these data points here. And first thing, let's talk about the new set of tariffs, because I have a few different thoughts on this.
Okay.
The first is I have no idea if these are going to be in place by the end of September for two different reasons. The first, they could pivot again and say 90-day pause. Plausible. Like, completely plausible. Am I wrong?
No, very plausible.
The second, these could all be invalidated by the Federal Circuit Court of Appeals, and the Trump administration might just say, okay, we're dropping this, and we're going to move on and do it a different way.
And by the way, the questions, the court case was going on at the Federal Court of Appeals yesterday, and the questions from the judge panel was, they, at least to me, seemed rather suspicious of the president's power to use these tariffs in the way that they have been doing so. Neither of us are legal experts, so I don't want to speak out of hand here, but they had some very pointed questions about why this administration believes that they have these powers under the rules that they are using. So that could be.
Or this could end up with the Federal Circuit Court of Appeals saying, yep, we're going to, invalidate these, but the Trump administration decides, nope, we're going to take this all the way up to the Supreme Court. And maybe the Supreme Court feels the same or differently. Like the legality of these tariffs could be in limbo probably through the end of the year.
Yep.
So there's a plausible case where I could sit here and say, hey, none of these tariffs on a country-specific basis are in place December 31st. There's a case that you could say, hey, we revert back to 10% by then. There's a case where the ones announced yesterday are in place. There's a case where there are higher ones in place. It still is something where I don't know how one constructively can say, I know what the tariff picture is going to be 3 months from now.
I would agree. What I do think is that investors generally didn't expect August 1st to come with these announcements, because I was listening to, Ernie Tedeschi runs the economics, I think the entire economics department of Yale, who's been doing all of the analysis on these tariffs. And he was doing an interview this morning, and he said, look, the tariffs that were announced today, because there were many things like Mexico where it delayed the implementation for 90 days, because there were certain countries like Thailand where the tariff rate actually went down, the average effective tariff rate compared to where we thought it would be 48 hours ago has not changed. What's changed is seemingly investors' perception of the seriousness of these tariffs. If they stay in place here, the budget lab at Yale, for those who are unfamiliar, has been doing all of the kind of front and center research on the effect of tariffs, where they bring us when we quote things like the highest tariff rate since the 1930s. They're the ones who have done these calculations. But they didn't change meaningfully from 48 hours ago. With all these announcements that were made, what seemingly changed to me was the investor sentiment on the seriousness of these tariffs, which, I don't know, maybe not. Recent history would tell us this ain't going to be where we land.
Right, like I'm sorry, but it kind of feels like Groundhog Day here.
Yeah. How many times do we have to get Charlie Brown with that football?
We did this one 4 months ago.
Yeah.
Almost to the day, by the way.
Yeah.
And so part of me looks at this and is like, okay, like if you're actually betting on this, don't you kind of bet that this doesn't end up happening, at least in this fashion? Like, maybe instead of the rates announced here, again, I'm just charting out like plausible paths. Hey, maybe, a week and a half, 2 weeks from now, it's, you know what, we're not going to do this. Instead, the blanket 10% is going to be 12.5. Couldn't you see that? Or the blanket 10 is going to be 15.
Yeah, you could very much see that, and I think it's more likely to go on a country-by-country basis. We've seen what happens when certain countries are able to leverage their own pressure, like China and their rare earth magnets, and there were some big changes that were announced that will directly affect China as part of the August 1st announcements here. So, yeah, it is really tough to know where this goes. And I even wonder, like, I had prepared a bunch of stats on what this all means should these tariffs stay in place, but quite honestly, I'm just not sure how worth it is reporting given how much other information we have to get to.
We've been down that road before. So the big thing, these new tariffs potentially going into place in a week. The only thing that I'll say, we're just now starting to see the first wave showing up in the customs data. June was the first month where we saw the average effective tariff rate come in. Let me just get this right. I just want to make sure that I phrase this right here. Okay, here we go. Yeah, so when you look at the imports and exports data, the big thing that we saw was the month of June was the first month where the effective tariff rate paid was north of 10%. And remember, when a company imports something, it takes 30 to 60 days from importation to it showing up on store shelves. And so you're just now starting to see, the potential impacts there. The concern that I have about higher tariff rates, hey, you're just starting to see the impact of the first wave. Now you're raising them again. How do companies deal with that? They've been able maybe to absorb the first wave decently enough, even though earnings reports this week and last will tell you it's been dodgy for a bunch. How do these new higher rates affect them? We're going to have to see how this plays out if these stay in effect. So, anything else we want to talk about on tariffs?
I do have one brief thing that I want to talk about on who's paying the tariffs according to that Yale Budget Lab. Let's take a quick break. We'll come back with that, and then I know we got to get onto the jobs report and everything else that came out this week. So quick break. We'll be right back with that next.
Breaking business news as it happens, only here on the Financial Exchange Radio Network. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
The future doesn't plan itself. Hi, this is Mike Armstrong from the Armstrong Advisory Group. Whether you've built a business, grown your investments, or simply want to protect your family, your legacy deserves more than a generic estate plan. From wills and trusts to beneficiary designations and beyond, true wealth transfer is personal, powerful, and deeply strategic. That's why we created Leaving a Lasting Legacy, a comprehensive guide to legacy planning that puts your vision, values, and family first. Learn how to protect your assets, avoid probate, minimize taxes, and build a legacy that lasts for generations. Get your free copy of Leaving a Lasting Legacy today by calling 800-393-4001. That number again is 800-393-4001, or you can request the guide online by visiting armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trusts to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing & Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Let's talk LDL. AKA bad cholesterol. The higher your LDL cholesterol, the higher your risk of a heart attack or stroke. Your health matters. Know your number. Talk to your doctor and get your cholesterol checked. And learn how to help lower your LDL bad cholesterol. Because your health is in your hands. Find out more at heart.org/LDL.
Celebrate National Farmers Market Week, August 3rd through 9th. It's the perfect time to explore your local market and enjoy some peak summer produce, sweet corn, juicy tomatoes, berries, and more. Support local farms, eat fresh, and build community. Mass Farmers Market supports more than 200 markets across Massachusetts, growing food access and farm sustainability statewide. Find a market near you at massfarmersmarkets.org. That's massfarmersmarkets.org. Sponsored by Mass Farmers Markets.
The Financial Exchange streams live on YouTube. Subscribe to our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Mike, we got two more things actually to talk about on tariffs. You had one discussing who pays the tariffs?
Yeah, so I guess a few things. One, there's been questions by us, like who is going to end up paying this tariff? Because it will start showing up somewhere. It could be paid by foreign manufacturers of goods that come into the United States, right? The idea of Walmart driving a higher bargain with their Chinese suppliers to say, hey, we need some help here. It could be paid by companies who absorb the cost increase of tariffs without passing it on to consumers. And finally, it could be borne by consumers, or more likely a combination of all of these. What the Yale Budget Lab is finding so far with tariffs that are substantially lower than what we are now expecting with the August 1st, or at least what we're now being told. I don't know if we're fully expecting 18% effective tariffs. What the Yale Budget Lab has found is, look, the foreign suppliers of goods do not seem to be absorbing this. You see this because we measure import prices. And so if you are seeing foreign suppliers of goods on the average take some of this cost, then you would see import prices falling. We're not seeing that. So likely not being borne by those foreign suppliers of goods. What the Budget Lab found so far on the tariffs that are being paid is that there's been about a 70% pass-through to consumers, and generally they expect that to climb. A lot of the tariff, for instance, by Ford has been absorbed so far, but they've kind of hinted that they won't be able to do that forever. And so that's kind of the baseline case here is right now, these tariffs that are in effect, about 70% is being passed along to consumers, 30% being eaten by U.S. companies. As time goes on, most expect that to climb. If it were 100% pass-through, then you'd be looking at an average increase per household of about $2,400 per household. That would take, obviously, a few years to actually get there, though. So
the other piece,
that's my take.
The other piece that I wanted to mention, as part of this tariff announcement, there's a blanket 40% transshipment rule that goes into effect as well. And this is not just transshipments from China. This is from anywhere. So it's basically, hey, if you try to avoid these tariffs or reduce them by shipping to a third country first, we're still going to hit you with that 40%. Now, how do you enforce that and everything? Viable question. But from what I've heard, Customs and Border Patrol has been pretty aggressive in looking at shipments and trying to, actually get appropriate values for the stuff that's shipped and, appropriate locations of production. So this is another piece that is in there. And again, the piece that I do find interesting, when you talk about transshipments, ultimately there's one country that matters.
China.
It rhymes with, yes, it's China.
Yeah, sorry, you were getting there. But yeah, when it comes to this stuff, just to explain how this transshipping works, right? The idea is very simple. China manufactures something, they send it to Vietnam, who puts in one screw, for example. They don't substantially change the product, but it gets shipped to Vietnam, they label it as made in Vietnam, and it skips whatever the high tariff burden would be in China. This is what's trying to address this, and it does require some judgment, right? It's a question of, was the product substantially changed in Vietnam or whatever country it gets shipped to? And that's a bit of a judgment call, but to your point, the Customs has been pretty aggressive in trying to enforce this. Almost certainly, it's a shot of the bow at China, and that gets discussed in these ongoing negotiations that are apparently happening over the next 2 weeks.
And two things. One, we love to toot our own horn on the financial exchange. We're very humble about the tooting, but we love to do it.
I wouldn't say so.
No,
I try not to be humble on tooting my own horn. Yeah.
No. We're humble in that, like, we don't take any great pride in tooting. Yes, we do. We love to.
Yep.
When the Vietnam deal was announced, which, by the way, Vietnam still has not confirmed, we said one of the parts of that was a 20% tariff on Vietnamese imports with a 40% tariff on transshipments, and we said, look out for that to become a bigger part of U.S. trade policy going forward. Welcome to August 1st. It's here. So we got that one right. So I like to say that. We're wrong a lot, too, but we don't bring that back up quite as much.
I try to.
I do, too. Like, again, we got to keep the scoreboard. Like, sometimes we got to be like, yep, we screwed up on this one. Like, it's important to actually try to keep score and say when you're right and when you're wrong. You can't just say stuff and let it go, forever. I had another point I was going to make, and it got lost somewhere in that shuffle.
Well, that's okay.
Oh! Nope, that's not it. Nope, I thought I had it, and then that wasn't it.
Okay.
I can't get there. I don't know what it is. But that 40% transshipment is, kind of a big blanket thing now. Here was the other point on it. Yes. Mike, do you think that it's a coincidence that announcement is happening right as the U.S. and China are in the midst of discussions about this August 12th deadline?
No, obviously not. It's something that you can take away as a negotiating point if you so choose. You're resetting the goalpost again.
Correct. It feels like the U.S. trying to, say, okay, like, this is something so we don't necessarily have to give something somewhere else. I like that. Let's take a quick break. When we come back, we got Wall Street Watch, and then we're talking jobs.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Sometimes we know what's next. Other times, it's impossible to know. Life can change in an instant. Don't be caught standing by the next time someone's heart stops. Knowing CPR gives you the ability to act and takes you from bystander to lifesaver. CPR is a life-saving skill. Join the nation of lifesavers today by learning CPR at heart.org/nation. National support for CPR education provided by Elevance Health Foundation.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams, your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we have a new guide available this month titled Leaving a Lasting Legacy. Mike, when it comes to naming beneficiaries on different accounts, what's the thought process that people should be starting with?
Well, first and foremost would be probably you want to do it. I know that seems so basic, but Chuck, I mean, how frequently do we run into this where forget about your investment accounts. Usually those are getting looked at. Your 401k, it's one of the first things you get asked. But I run into people every day that don't realize they can have beneficiary designations on bank accounts, for instance. And what an easy way to avoid frustration after you're gone.
Can you talk a little bit about how much time and effort that can save someone after a loved one passes away when it comes to being able to inherit assets quickly?
Anyone that's been through probate will know the answer to this, but these things can last a year, and it doesn't matter if it's a $5 million estate. Obviously, that's pretty complicated, but a $10,000 checking account could also need to go through probate, and it could take an equal amount of time depending on the complexities involved. And so there are a lot of benefits that are out there when it comes to just utilizing the tools that are made available to you, and beneficiaries is a big one.
Folks, the guide is titled Leaving a Lasting Legacy, and the way to request it is by calling 800-393-4001. Again, the guide is titled Leaving a Lasting Legacy. It discusses beneficiary designations and a whole lot more. And the way to request it again is by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets selling off this morning after President Trump modified tariffs on several countries ranging from 10 to 41% late last night. That will begin on August 7th. Furthermore, Wall Street is also sifting through the July jobs report, where 73,000 jobs were added last month, softer than estimates of 104,000. The weaker than expected jobs data is sending Treasury yields lower as traders reassess the chances of a Fed rate cut in the fall. At the moment, the Dow is down by 1.1% or 504 points lower. S&P 500 down 1.2% or 80 points lower. And the tech-heavy NASDAQ selling off by over 1.5% or 334 points. Russell 2000 is now down 2.3% or 51 points lower. 10-year Treasury yield down 10 basis points at 4.251%. And crude oil down nearly 2% lower, trading right around $68 a barrel. In what would normally be the top story of the day, Amazon and Apple reported earnings after the bell yesterday. Amazon down by 6% after the e-commerce and tech giant offered a disappointing forecast where its cloud business wasn't growing as fast as its competitors. Amazon did, however, see a sharp increase in sales and profit for the previous quarter. As for Apple, the iPhone maker handily beat street expectations for for the second quarter, driven by consumers rushing to buy devices before potential price increases from tariffs. Overall sales were up about 10% higher on the year. Apple shares retreating by about 1%. Elsewhere, cryptocurrency exchange operator Coinbase missed revenue expectations amid a slump in crypto trading activity, sending shares down by 14%. And social media platform Reddit seeing its stock surge by 17% after it beat second quarter expectations and offered a stronger than forecasted third quarter guidance. I'm Tucker Silva, and that is Wall Street Watch.
Mike, so we got a jobs report this morning at 8:30 a.m., and here are the highlights of it, or in some cases the lowlights of it. Wasn't great. 73,000 jobs created for the month compared to expectations of 110. Quite honestly, it's within the margin of error. I don't really view that as being anything awful. Like, it's fine.
That wasn't the problem. When I first saw this released at 8:30, I said, okay, fine.
Now, the last 2 months, I'm going to quote here just because I like their quotes. The change in total non-farm payroll employment for May was revised down by 125,000 from 144,000 to 19,000, and the change for June was revised down by 133,000 from 147,000 to 14,000. With these revisions, employment in May and June is a combined 258,000 lower than previously reported. So, what this does mean is that for the last 3 months now, you've averaged 35,000 jobs created for the month.
We previously, as of last month, thought that number was, what, somewhere in the hundreds?
Yes. And this is not good. We don't know exactly where in any particular point in time you need to be in order to break even. Historically, the last couple of years, it's been around 125 to 150,000.
Explain break even.
Basically, how many jobs do you need to add in order for the unemployment rate to not go up?
Mm-hmm.
And so you've been around 125,000 to 150,000 needed for it to not go up. But demographics have continued to shift in the U.S., so you have more boomers retiring and fewer Gen Zers coming in order to replace them. But the other piece, remember this year, you've got this uptick in deportations that's happening, and that's impacting the labor force as well. So the estimates that I've seen as far as how many jobs you need to produce each month in order for unemployment to not go up now is closer to like 50 to 90,000 a month. But no one's quite sure exactly where it is. But either way, 35,000 jobs added a month over the last 3 months is on the low end. It starts to look a little bit dodgy there.
Chuck, we usually say that any one data point doesn't make a trend, doesn't really matter. This one data point to me matters quite a bit.
It matters because it changes the trend for the last 3 months.
Right.
Because it's really not one data point, it's three that we're looking at here.
Yeah. And when you have such a significant revision, which, by the way, when you're having big revisions like this, especially to the downside, it's usually not indicative of a healthy economy. Remember what these estimates are. These are estimates that they get from surveying businesses. And what this means is that the businesses that took a while to respond ended up either not hiring very many people or firing some people, which, again, if you're not meeting the deadlines for responding to this survey, maybe your business is under pressure. It's just not a terribly good sign of the state of demand for labor. The big piece that the Federal Reserve is focused on right now, though, or at least it seems to me that they're focused on quite a bit, is the supply of labor. And to your point, that is really tricky right now. That is really, really confusing.
And here's the whole ball game, quite honestly, in terms of like why the Fed is in a pickle right now. Is so the last 3 months, non-farm payrolls have increased by 35,000 a month, which is decreasing from where it was. This is the slowest 3-month stretch of payroll gains that we have seen since late 2010. So, just to put this in perspective, I'm not including the pandemic because of obvious reasons. On the other hand, the year-over-year wage growth for hourly earnings from the same report is coming in at 3.9%, which is an uptick from the last couple months.
So
this is the
less
troubling
demand
piece.
for labor, but the labor that you do have is getting paid a lot more.
Not a lot more. Like it's
3.9% is not a small number, but
no,
yeah.
but like you look at like 2018 and 2019, and we were running like 3.25. So it's I'm not going to look at this
Sure.
and be like, hey, red alert, like big problem. But like you look at how you get to a stagflationary place, it's with slowing job growth but increasing labor cost. And like that's not a great place to be. And this is why the Fed is in a pickle now. The counter to this, in terms of the Fed being in a pickle, we've talked an awful lot about Chris Waller, who is actively running to be the next Fed chair.
Yep.
And I've said, look, Waller's basically been right about this economy for a while now. And he's pretty vindicated because he's been saying for the last few months, guys, like there's some weakness in the labor market. You got to pay attention to this. You got to get ahead of it because if you're too late, there's going to be a problem. And I think he kind of vindicated on there. But the other piece that I think is interesting just to think through. Well, there's a few. Again, there's so much meat here. There's just a lot. Doesn't this really indicate, if the revisions down are for the months of May and June, it's indicating, hey, companies, after the tariffs were announced, kind of paused hiring on a net basis during that time. Is that right? Like that's a fair way to look at it.
Yeah, whether it was directly because of the tariffs or not, after the tariffs, they slowed down hiring. That is pretty definitive from this
If I'm
data.
trying to build a story around this, which is all
Yep.
any of us ever do, because none of us know for sure, a plausible explanation is, hey, in May and June, companies slowed hiring because they were trying to sort through their business plans on tariffs.
Sure.
Got it. This also matches up with what we saw with continuing claims for unemployment during that time, where it was starting to get concerning there. And initial claims are moving up, but we think the initial claims thing is a seasonality thing, so not too excited. But in the last couple weeks, initial claims are now running way below last year. Continuing claims have come back into line with expectations for where we thought they would be this year. And so if you want to say, hey, maybe the Fed's justified in not cutting, I'm not saying that they are or aren't. I'm just saying, like, if you want to build an interesting case, the case you could make is, yeah, the labor market slowed in May and June, but subsequently is showing some signs now of reacceleration. And so maybe the Fed should wait because the slowing already happened and now we're on to a new impulse now that companies have sorted through that initial wave of tariffs.
That could be the other piece that I'll quote from Jay Powell on Wednesday of this week. The main number you have to look at now is the unemployment rate. He already took a step and said, I don't really care about the job creation rate right now as much as I care about that unemployment rate. And he's talking about labor supply and the potential inflationary impulse there. So, yes, is Waller feeling a little bit vindicated this morning? Probably. Does Jay Powell think that this report changes his view on where interest rates should be? Probably not. You did not see an uptick in the unemployment rate significantly. Went from 4.1 to 4.2. Not meaningful.
No. And this is because ultimately, look, if you have a labor force that isn't growing much, what are the Fed's two mandates? Maintain price stability and full employment. The Fed's job is not to add 100,000 jobs a month. It's to maintain full employment. If you have the labor force growing by 500,000 people a month and you have a jobs report like this, Fed's going to cut because unemployment's also going up to 4.7 then.
Yeah.
If you have a labor force that's shrinking and you get this kind of jobs report, Fed kind of says, okay, like we'll watch because, you never like to see job growth slowing that much. But ultimately, if you're still near full employment, what are you going to do? One other thing that I find really interesting. Do you remember the last couple months, those ADP reports kept coming out, and they were, below what we were seeing from the BLS, and everyone's like, oh, like, silly, stupid ADP. What a bunch of idiots. What a bunch of maroons. How could they come up with those numbers?
They were right, yeah.
It's not that they were right. No one's right or wrong because these are statistics.
Yep.
Like, no one knows who's right. The interesting thing is, it's not... The interesting thing is if you look at the 3-month average of ADP and both private and total payrolls from this report, all three of those lines are almost identical for the last 6 months now. So the revisions have brought this in line with ADP. Like, I'm not saying, like, hey, everyone should pay attention to ADP. Not that, but very much, kind of interesting how after some revisions, these end up coming in pretty close to that ADP report. Just a couple other things that we're seeing that are problematic in a few different ways. Labor force participation continues to decline, now down to 62.2%. That's off a cycle high of about 62.8%. Not entirely surprising given demographics. The labor force participation likely will continue to. Employment to population ratio also declining to 59.6. Cycle high was in the 60.5 to 60.7 range. Generally, when you start seeing a drop in the size of the workforce, it means lower GDP growth, so that kind of meshes with what we saw in the first part of this year. Finally, the U6, the underemployment rate, rose again from 7.7 to 7.9%, so that's saying, hey, the unemployment rate's 4.2, that's the percentage of people saying, I don't have a job but want one. 7.9% of people are saying, I don't have enough job. I need more job. Chuck need more job. Like that's what people are saying. When the underemployment rate goes up, people need more job. Let's take anything else to do on this?
I don't think so. It's, again, coming at us a mile a minute, but I think we can move on from jobs now.
Okay. Let's move on from jobs. And let me just make sure I've covered everything I want. I'm just scrolling through different charts just to make sure that I got to everything that I had here. Actually, I've got a couple more jobs things. So let's take a quick break and more jobs after this.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Like us on YouTube and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. When it comes to legacy planning, having a will is important, but it may not be enough. A will only covers probate assets, and the probate process can be slow, public, and expensive. That's where trusts come in. Trusts can help you avoid probate, keep your wishes private, and control how and when your assets are distributed. Whether you're looking to support family, minimize taxes, or prepare for the unexpected, a well-designed plan can make a meaningful difference. Our new free guide, Leaving a Lasting Legacy, covers wills, trusts, and other strategies to help you build a strong retirement plan. Take the first step towards clarity by calling 800-393-4001 right now and asking for your free guide today. That number again is 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com. Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trust to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing and Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
As a busy mom to 4 kids, my to-do list is full.
Trying to fit in exercise, eating right, and prioritizing self-care can feel next to impossible.
While we can't add more hours to the day, we do have a great resource to help.
Go Red for Women has easy tips, tools, and information to help you and your family live a healthier life.
So to all the moms, the aunts, grandmothers, and amazing women out there doing it all,
visit goredforwomen.org/momlife today.
You take care of them, Go Red for Women will take care of you.
Celebrate National Farmers Market Week, August 3rd through 9th. It's the perfect time to explore your local market and enjoy some peak summer produce, sweet corn, juicy tomatoes, berries, and more. Support local farms, eat fresh, and build community. Mass Farmers Market supports more than 200 markets across Massachusetts, growing food access and farm sustainability statewide. Find a market near you at massfarmersmarkets.org. That's massfarmersmarkets.org. Sponsored by Mass Farmers Markets.
Business and financial news affecting the markets and your wallet. We've got it all straight from Wall Street right here on the Financial Exchange Radio Network.
The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts, and now's the perfect time to register for this year's 5K at Castle Island by visiting dav5k.boston. The event will sell out again, so if you're interested in participating, now's the time to reserve your spot. Come out and help support our great American heroes by joining us for the DAV 5K. Visit dav5k.boston to register or to make a donation today. That's dav5k.boston.
Mike, couple other things that I want to touch on with the jobs report.
Yeah.
First, manufacturing sector, something that everyone always loves to focus on. In the last 12 months now, the U.S. manufacturing sector has lost 113,000 jobs on a net basis.
What's the total? Do you know what the total employment is in the manufacturing sector? How significant is that?
Yes, I do know what that is, actually. It is about 12.7 million. So it's about a 1% decline in the last year. A little bit less than that, but like right around that ballpark.
Yep.
This, by the way, has been going on since October of 2023. So this is not a new phenomenon. It's not related to anything, on trade or whatever. This has been going on for the better part of a year and a half. It's not related to anything specific to what's going on in the economy today, but just notable in terms of where manufacturing job growth is. We were seeing some big gains, obviously, in 21 and 22 coming off of the pandemic, and also in President Trump's first term, you saw really big manufacturing job gains as well. By July of 2018, we were adding 286,000 jobs a year in manufacturing. This time there's a different set of circumstances, and this is something that we talked about around the election, where it's just a different economy than the first time he was in office. So that's one thing that I wanted to point out. Another thing, and this is from Parker Ross, who works at Arch Capital Group. And when talking about like that labor force participation rate and why it matters for the unemployment rate, Parker has a great chart that is available on like every social media platform today. And what it shows is that, look, if you held the labor force participation rate stable at where it was in April, so saying, hey, the labor force participation is not declining, like it's just where it was in April, the unemployment rate would be 4.9% now instead of 4.2%. Like, that's the whole ball game right there.
Yeah.
Is if we're wrong about the labor force participation rate and it still is where it is in April, then unemployment's way higher than we think it is right now. Counterpoint to that, hey, if the labor force participation rate is actually lower than we think it is right now, unemployment might be like 3.7, but I don't hear a ton of people saying, gee, like, it's such a competitive job market, there's no one unemployed. I hear the opposite. So, again, just food for thought. I'm not saying the unemployment rate is 4.9, but much more, hey, the reason why the unemployment rate isn't looking worse is because a higher percentage of people are out of the workforce now than 3 months ago.
Well, believe it or not, the holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away, and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Mike, just a couple other stats that I found interesting in the jobs report. More about that labor force participation. This is the third straight month in a row that the labor force has declined. The last time that happened was 2011. So it's been a while since we've seen that.
Which, again, I do think that meshes with what we are seeing from both baby boomer and migration perspective here, right? Like there are very few border crossings. There are very few illegal boarding crossings in particular right now. And it does mesh out with, that labor force would seemingly at least slow down, if not decline.
And so it's kind of this thing where, like, think about this from the perspective of a company. I don't need to hire many people, but someone just left and I need to hire them, and I got to pay more for that person because there's not enough labor. Quick break here. We got a lot in hour two. All those earnings from yesterday, we're talking those and a whole lot more.
Here at the Massachusetts Department of Elementary and Secondary Education, we are committed to all students not only attending, but succeeding at school. Your presence is powerful. Share why you attend at doe.mass.edu.
Sponsored by the Massachusetts Department of Elementary and Secondary Education.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
Did you outgrow your timeshare and now you want out? But you can't. You can't sell it, and you can't get out of the contract. Imagine trying to get out of your mortgage. That's what a timeshare is. You can't just call up the bank and say, I don't want to pay it anymore. But we may be able to help you do just that. Listen, a timeshare maybe for you once was a great thing, but now you don't use it much. And they are not easy to get rid of. Plus, you do have to pay for it every month. Qualified timeshare owners can get out of their contract legally and permanently without ruining your credit or even filing bankruptcy. And imagine, no more mortgage payment or fees. Call the Timeshare Exit Hotline qualification line now. It's free to learn more.
800-455-7967. 800-455-7967. 800-455-7967. That's 800-455-7967. Paid for by Timeshare Defense.
The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Hi, this is Chuck Zodda from the Armstrong Advisory Group. If you have an IRA, it's critical to understand the tax rules that may affect your family as you plan for retirement. Current law requires most non-spouse beneficiaries to withdraw the full balance of an inherited IRA within 10 years, which may lead to higher taxes and reduced value over time. If beneficiary designations are outdated or incorrect, they could possibly override your will and change how your assets are distributed. That's why we're offering a new guide called Leaving a Lasting Legacy, a resource to help you better understand inherited IRAs and other legacy planning topics that could affect your future. Make an informed choice and take control of your plan. Call 800-393-4001 and ask for your free guide today. That's 800-393-4001 or request your copy online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today, we're talking about your new guide, Todd, Demystifying the Top 7 Estate Planning Trusts. Now, do you lose control if you transfer your assets to an irrevocable trust in order to protect them from long-term care expenses?
Well, that's great when you mention that irrevocable trust, but limit it to the kind of trust where you're protecting it from the cost of long-term care. Because as the guide says, there's 7 different kinds of trusts that we're trying to demystify. And there's also many kinds of irrevocable trusts out there, not just one type. So many people think there's just one type. But this particular type, where you're trying to protect it from the cost of long-term care expenses, the answer is no. You do not lose control over your assets. There's a whole spectrum of control with irrevocable trusts. And this one, you keep about 95% control control. Like you can live in your house, you can sell your house, you can buy another house, you can invest your money, you can manage your money, you can collect the income. Even the tax liability of these trusts are designed to be at your own rate. In other words, they are grantor trusts. You don't even pay any higher income taxes when you have this irrevocable trust. So this kind of trust, folks, you keep control and you protect your assets from the cost of long-term care.
Call right now for your free copy of Cushing & Dolan's comprehensive guide titled Demystifying the Top 7 Estate Planning Trusts. It will help you determine what type of trust is right for you and your family. Call 866-848-5699. That's 866-848-5699. Or you can request it from LegalExchangeShow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Armstrong do not endorse each other and are not affiliated. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong Advisory and the advertisers heard on this program do not endorse each other or their services. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Mike Armstrong. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. This is the Financial Exchange with Chuck Zodda and Mike Armstrong.
Chuck, Mike, and Tucker with you, and markets not in a great spot today. The Dow is off 582 points. S&P's down 100. NASDAQ is down 435, so about a 1 1/3 to a 2% decline in markets today so far. Things that can be causing it, we had a jobs report this morning that was weaker than expected, some new tariff announcements last night, and some earnings. And Mike Santoli is going to be joining us from CNBC in about 10-15 minutes. So he'll get us caught up on a decent chunk of what's going on in markets. But I wanted to kick things off by talking about earnings from yesterday for our other two big tech companies that we're reporting, Amazon and Apple. And I'd like to start with Amazon, Michael, if that's okay, just because
it's a good contrast to what we got yesterday.
Well, it's just sexier. Whenever a stock moves 7%, it's more interesting to talk about than the one that is moving 1%.
Mm-hmm.
So let's start with the big one. The unfortunate thing for Amazon is that 7% is down, not up. So why is Amazon off 7.5% today? What gives? I'm going to quote Luke Kawa here from Sherwood News, who, by the way, Tucker, just I'll say this publicly, Luke is a great guy that we should reach out to try to talk about some of this stuff in the future. So put his name on whatever list you keep for interviews, because he's awesome. So this is he wrote a piece about Andy Jassy's earnings call, and I think it all boils down to this. This is a quote from Amazon CEO Andy Jassy, who no one really knows his name. Everyone still thinks Bezos runs the place, but it's not.
No.
Jassy said, when asked about AWS, Amazon Web Services, and what kind of AI growth they were seeing, quote, "Regardless, these are all just moments in time. The last week is a moment in time, too, where the reality of what really matters is what customers' experiences are in operating these platforms."
What?
Here's Kawa's response. "I'm reminded of the moment in Blow when Johnny Depp's character waxes philosophical on the nature of his alleged crime in the judicial system while offering his plea. The judge's retort, 'Unfortunately for you, the line you crossed was real and the plants you brought with you were illegal, so your bail's $20,000. And this is the whole thing, is Amazon did two things yesterday. They had a good quarter, and then they gave weak guidance and couldn't answer any questions about AI in any constructive fashion.
Not great.
not great. So the stock's down 7.5%. There's not much more to it than that.
It's easy to compare and contrast, too, because you had Google and Microsoft, who have both already reported earnings to this point, telling us that they saw pretty tremendous artificial intelligence growth on that side. So it's easy to look at this and say, here you are, here's your competition, how are you going to improve it? And the CEO seemingly had no response. I did have...
And that no response, by the way, during the time that he uttered that, the stock went from 226 to 220.
Yeah.
Like Luke has the minute-by-minute chart of the earnings call and showing exactly when he said that and when the stock went down, and that was it.
So we were talking a bit yesterday, Chuck, about why are certain companies benefiting from AI so much, Microsoft in particular. And I had someone in an interview that I listened to explain it pretty concisely, which is both Microsoft and Google, who do this, have retail-facing AI platforms that are being used on their servers. In Microsoft's case, they are mainly hosting ChatGPT. Yep. In Google's, they have Gemini, and so they're seeing that tremendous growth. Amazon Web Services does have some of this. Largely their artificial intelligence platforms, though, are those that are being hosted by big major corporations. They are not retail-facing. They are private sector, and frankly, the uptake there has been slow. It has been really slow. And I'm disappointed that we heard nothing from the CEO on this, because the analyst opinion was, look, if Amazon is going to succeed here, it's going to come from that private sector piece of this, companies like JP Morgan, if you will, who are pushing AI internally, developing their own models, and intend to expand them, but are doing so cautiously and intentionally, and Amazon Web Services would benefit from that. Does that actually come true? Will it materialize? How long does that take? Are all questions that Andy Jassy is going to need to answer in pretty short order.
Yeah, so I think ultimately when it comes to Amazon, it's, hey, the core retail business is retailing along. There's no huge shift in trend there. AWS is growing, but the other guys in the cloud space are growing faster, and they don't have a great answer on AI. So how can you slap an AI multiple on Amazon if they're not AIing? Is the fancy way of saying it, I think?
Yeah, sure.
Let's take a quick break here, but when we return, we're going to be joined by Michael Santoli from CNBC. We're talking about what is going on in markets, and also we still have Apple earnings to get to as well, and so we're going to make sure that we cover those when we're back.
Find daily interviews and full shows of the Financial Exchange on our YouTube page. Subscribe to our page and get caught up on anything and everything you might have missed. This is the Financial Exchange Radio Network. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trust to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing and Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy, or request it online at LegalExchangeShow.com. The proceeding was paid for, and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
Celebrate National Farmers Market Week, August 3rd through 9th. It's the perfect time to explore your local market and enjoy some peak summer produce, sweet corn, juicy tomatoes, berries, and more. Support local farms, eat fresh, and build community. Mass Farmers Market supports more than 200 markets across Massachusetts, growing food access and farm sustainability statewide. Find a market near you at massfarmersmarkets.org. That's massfarmersmarkets.org. Sponsored by Mass Farmers Markets.
The Financial Exchange is live on SiriusXM's Business Radio Channel 132, weekdays from 11 to noon. Get the latest business and financial news from across the country and around the world, and keep up to date on how it might affect your wallet. That's The Financial Exchange, weekdays from 11 to noon on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. 3 stunning islands, St. Croix, St. Thomas, and St. John, all just a quick flight away. No passport required, just sunshine, soft sand, and that warm island vibe. Craving a break? Well, plan your fall escape now and experience the beauty of America's Caribbean paradise, the U.S. Virgin Islands. Book today at visitusvi.com. That's visitusvi.com.
Joining us now is CNBC's Michael Santoli. And Michael, we've been describing this week as the busiest week of the year for economic data, market data, and everything else, and it is certainly delivering. I want to start off with you. 1, thank you for joining. 2, I was hoping we could start off on the most recent data, which would be this morning's jobs report. And on the surface, 70-something thousand jobs created, slight uptick in unemployment rate. But you dig in here, and it was a pretty weak jobs report. How are you looking at that this morning, and how do you think the Fed is?
Yeah, it's pretty hard to escape the conclusion that it is pretty weak, and it shows a labor market kind of at stall speed. Really no net job creation, at least after those revisions for the last few months. We can basically take that as, businesses are kind of in watch and wait mode, waiting for things to crystallize in terms of tariffs, in terms of tax policy, whatever it might be, alongside, what's been a little bit of a general deceleration and a demographic shift. And, we get 200,000 boomers retiring every month. So it's kind of sluggish in the backdrop anyway. And it definitely does skew the perception of risk slightly to the downside for the economy. One of the reasons I think markets have been able to perform so well up to this point this summer is you were able to say we have an economy that's resilient enough to withstand a Fed that wants to watch and wait for a while longer. And this kind of, brings it into question just slightly. I mean, look, we're up a lot. Markets are due for a break. We have weak seasonal patterns starting in August, all the rest of it. But it does seem as if we got ourselves priced for, a kind of a Goldilocks backdrop along with this real enthusiasm on the AI front. And right now we're having some indigestion on that.
Mike, on that front, I mean, it's pretty clear from this report that second quarter labor demand was relatively weak. I'm still having a really tough time understanding the supply of labor equation. You hinted at it, but that unemployment rate barely climbed back up to 4.2%, and that's seemingly what Jay Powell is concerned about right now. And so, how do we measure the competing risks here for the Fed of higher unemployment or higher inflation when you have a kind of confusing report like this?
Yeah, it's tricky because, well, for one thing, obviously the immigration restrictions and crackdowns is restricting labor supply along one front. You do have a slight downtick in labor force participation. So if you look at prime age employment as a percentage of the overall population, that's ages 25 to 54, it's really had a pretty significant decline in recent months. So that tells you what's happening on the supply side of the labor market. Is basically either people seeing it's tougher to get hired and they're not looking, or you have just fewer people out there looking. Powell has characterized this as a labor market imbalance, right? And as you say, they're keying off the unemployment rate, which is not necessarily comforting in the sense that it can often be lagging. Right. And even this month, I think it came in unrounded at 4.248. Yeah. So in other words, it was a tiny bit from being rounded up to 4.3. I mean, it's kind of slicing it pretty thin there, but I do think that's why it's a little bit tough to get a clear read on the trajectory.
So let's shift over then to White House tariff policy. A slew of announcements from tariff increases, suspensions over the last couple of days. Obviously, Yale Budget Lab has been front and center on all this. But as an investor, given the lessons since, let's call it April 2nd, how do we navigate these announcements when it comes to tariffs that are seemingly going into effect mostly a week from now?
Yeah, I mean, if then, right? I mean, apparently the White House has been telling our folks, like, don't put too much focus on that August 7th deadline. That's just to get the paperwork ready in case it happens. My point is, I think from an investor's perspective, I think we had worked ourselves into a position where we said, well, it's absolutely not going to be close to the worst case scenarios as detailed on April 2nd.
Yep.
And maybe we're settling out around 15%. If that's the case on a blended basis, we can kind of absorb that. I mean, honestly, it's a huge economy. We're not that trade dependent. It's going to hurt certain companies and sectors. It's not going to sink the overall economy, and at least we'll have certainty. Well, now we get this extra volley of hawkish trade policies or tariff rates last night, and it's like both we're not going to get resolved in a hurry, and maybe it's going to have to be higher. So I just think it's it just kicks up dust in the eyes of people trying to make decisions about their business and about the economy and what to spend. And I think that the market was sort of hopeful that we would, be moving toward a moment of clarity. We got the tax and budget bill in place and all the rest, and that 2026 is going to be a little bit of a clean read on things. Maybe it still will be, but I think this causes questions. And again, I always say the initial conditions of where the market was when all this happened matters a lot. And the market was calm and strong and expensive, and people were complacent. And so therefore, a little bit of a wobble here and a reset of expectations makes sense.
Speaking of a strong and healthy but expensive market, we had earnings from four major players in the U.S. market, Apple, Amazon, Microsoft, and Meta. What are your general takeaways here? Obviously, Amazon getting punished today, Apple a little bit as well. That seems to be just down with markets. What are your take from the big earnings this week?
I mean, the big takeaway is that there is no diminishment of the appetite for these companies to spend heavily on CapEx for AI build-out. And in general, the market is approving of that, especially in the instances where they see a direct line to business results. And that's most clear with Meta. Meta has a very good story to tell. Yep, they're betting the company on this stuff, but they're also earning money hand over fist, and they insist that AI is basically just making the product stickier and helping advertising revenue. And there you go. So if you're an investor, you see it kind of falling to the bottom line. Microsoft's similar. They can point to the subscriptions to their Copilot product and things like that. It's a little bit squishier. Obviously, Apple, I think that there's a high burden of proof that they've figured it out what AI means for them. But on the other hand, they're not spending a ton.
Right.
Whether the market wants them to spend more or not is a question. Amazon, I think, is suffering just from, the stock had a run. Relative to Microsoft's cloud results, wasn't the best. there is some tariff static around the retail business, and I think that it was just sort of, enough for now. In general, I've been surprised that the market is willing to pay premium valuations both for the companies spending all this money and the companies getting all this money, like NVIDIA and Oracle. So for now, kind of everybody wins. That this ultimately leads to an overbuild or basically, money wasted on some front, but the market doesn't think we're close to that yet.
One thing that confused us here a little bit yesterday, I mean, you had this big move from Meta. You had an explosion of spending across many of these firms. And yet those companies that should benefit from that increase in spending, NVIDIA, other semiconductor players, took a hit in trading Thursday. I mean, obviously there's an argument that maybe it's already baked in, but I'm just wondering if we're missing something here. If Microsoft and Meta and every other tech company out there is saying they're planning on expanding their spending in 2026, and yet those suppliers of where that spend should go are not seeing their stocks improve on the news, what are we looking at here? Is it just a shortage of what they're going to be trying to spend money on?
I'll be honest, I think it's mostly just kind of noise around the trend. I mean, NVIDIA has been nearly a double since the low in April.
Right.
Stop. Right. I mean, it's added $2 trillion in market cap in 4 or 5 months. So I think you have to kind of give it a little room to back off to some degree. And that's mainly would be my read. There is some question out there. I mean, they're constructing buildings, right, with all this stuff, and it's kind of almost stealing a lot of physical resources from the rest of the economy. There's a lot of stuff that basically tech capex is almost floating the GDP growth,
right?
As consumers kind of take a bit of a break. So it's pretty weird and unbalanced to have this be the thrust of this phase of economic growth. So I think that is the way I read it. There is some fatigue in the AI trade just because of where valuations have gotten. The NASDAQ 100, you want to call it that, it's basically as high as it gets in terms of forward PE outside of the pandemic in the last 25 years. Now, those earnings are still growing a lot, and NVIDIA is like making money hand over fist. In fact, at some point, the question would be like, what does NVIDIA do with all the money?
Right.
Because they're going to have tens of billions of free cash flow without any direct purpose for it. So it's a good problem to have.
Michael Santoli from CNBC joining us here this week. Michael, really appreciate having you here this week on a crazy busy week for data. Thanks so much for joining us, and we'll talk to you again soon.
You got it. Thanks very much.
All right, time for trivia here on the Financial Exchange. And on this day back in 1981, MTV made its debut at 12:01. It may be hard for anyone under the age of 30 to understand, but MTV actually used to play music videos 24/7. Now, well, not so much. So, trivia question today. What was the first music video played on MTV? Once again, what was the first music video played on MTV? Be the fourth person today to text us at 617-362-1385 with the correct answer, and you win a Financial Exchange Show t-shirt. Once again, the fourth correct response to text us to the number 617-362-1385 will win that t-shirt. See complete contest rules at financialexchangeshow.com.
Mike, anything else to add on Amazon earnings?
I don't think so. I mean, again, this is a company that's getting treated like another cloud company, and their cloud data was pretty bad. So regardless of what's happening in the retail side of the business, which is how all of us interact with Amazon and think about Amazon, is not quite as relevant as where the AI spend is going. And recently it's not towards Amazon.
Taking a look at markets as we head towards the bottom of the hour. We've still got the Dow off about 640 points now. The S&P's off about 104. NASDAQ off 452. So anywhere from about a 1.5% to 2.25% sell-off happening there. The Russell 2000, for those of you who observe, is down 2.5%. 56 points is the first time I've ever quoted the Russell in points. I honestly don't know why I just did that, but I'm sorry. And we've got the 10-year Treasury down at 4.241%, down about 12 basis points. The good news is for the housing market, that should seep through into rates, which should get them into the 6.5, like 6.65 range before the weekend. Not really enough to help housing, with that kind of move, but maybe we get some follow-through next week, and there's some beef there. Quick break here. We got Trivia Answer, we got Wall Street Watch, and then Apple earnings.
bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network. A trust isn't just a document. It's a powerful tool that can help protect your assets from the nursing home and even reduce or eliminate estate taxes. Cushing & Dolan are leaders in elder law, estate planning, and asset protection. This month, they're offering a free guide called Demystifying the Top 7 Estate Planning Trusts. This guide breaks down the most common types of trusts, explains the pros and cons of each, and helps you understand which might be right for you and your family. Trusts come with different rules, benefits, and tax treatment, and choosing the wrong one could cost you. Learning the differences now can help you make smarter decisions for your future and your loved ones. Trusts are a critical part of any well-designed estate plan, but they can be complex. Don't guess your way through it. Get the facts first. Call Cushing & Dolan now at 866-848-5699 to request your free copy, or visit LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The holidays are just around the corner, so now's the time to plan your winter escape. Trade in the cold for sunshine, sea breezes, and island vibes in the U.S. Virgin Islands, America's Caribbean paradise. Whether it's a romantic retreat, a family celebration, or a solo recharge before the new year, St. Croix, St. Thomas, and St. John offer the ultimate warm weather getaway. Lounge on sun-drenched beaches, explore vibrant culture, and celebrate the holidays island style. No passport, no hassle, just warm weather, clear blue water, and unforgettable memories. This is where the stress melts away and you find yourself naturally in rhythm with the heartbeat of the islands. Go to visitusvi.com and book your trip today. That's visitusvi.com. The U.S. Virgin Islands, America's Caribbean paradise. Your holiday escape starts here at visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and we've got a guide available this month titled Leaving a Lasting Legacy. Mike, one of the things that people have to navigate now is figuring out which accounts to leave to different beneficiaries. As an example, if someone has two children, one in a high tax bracket, one in a low tax bracket, how does that potentially impact who receives which assets?
Well, let's call it out. First and foremost, most commonly, people just divide equally.
Sure.
And there's nothing wrong with that. I get the fairness argument with all of this. But taking your example here, let's imagine we have one person with an average effective tax rate of 10% and another one with 25%. Obviously, there's going to be a massive difference in terms of what is left over with a traditional IRA, for example, for that person in the 25% bracket versus the 10. And so with the new rules over the last few years when it comes to requiring those accounts to be emptied over the course of 10 years in most cases, especially on the retirement account front, there's a lot of different stuff that can be looked at there. That doesn't even take into account things like non-retirement accounts, Chuck, right?
Sure.
So for those, you have a different set of rules that applies to those, generally pretty preferential tax treatment. And so you can be really intentional about how you leave the biggest legacy possible to your heirs as a whole.
Folks, the guide is titled Leaving a Lasting Legacy. The way to request it is by calling 800-393-4001. Again, the guide is called Leaving a Lasting Legacy, and the way to request it is by calling 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Markets in sell-off mode after President Trump modified tariffs on several countries, ranging from 10 to 41% late last night. That will begin on August 7th. On top of that, Wall Street also sifting through the July jobs report, where 73,000 jobs were added last month, weaker than estimates of 104,000. The softer-than-expected jobs data is sending Treasury yields lower on the day as traders reassess the chances of a rate cut in the fall. Right now, the Dow is down by 1.4% or 618 points. S&P 500 down 1.6% or 102 points. NASDAQ down now over 2% lower or 444 points. Russell 2000 down 2.4%. 10-year Treasury yield down 12 basis points now at 4.237%. And crude oil down 2.7%, trading at $67.38 a barrel. And what would normally be a top news story on the day, Amazon and Apple reported earnings after the bell yesterday. Amazon down by 8% after the e-commerce and tech giant offered a disappointing forecast where its cloud business wasn't growing as fast as its competitors. Amazon did, however, see a sharp increase in sales and profit for the previous quarter. As for Apple, the iPhone maker handily beat street expectations for the second quarter, driven by consumers rushing to buy devices before potential price increases from tariffs. Overall sales were up about 10% higher on the year. Apple shares down by 2%. And after its IPO yesterday, where shares more than tripled in its debut, Figma up another 5% today. Paul LaMonica of Barron's will join us in the next segment for his analysis on the design software vendor. I'm Tucker Silva, and that is Wall Street Watch. And in the previous segment, we asked you the trivia question. What was the first music video played on MTV? That would be Video Killed the Radio Star by the Buggles. Dean from Manchester is our winner today, taking home a Financial Exchange Show t-shirt. Congrats to Dean. We play trivia every day here on the Financial Exchange. See complete contest rules at financialexchangeshow.com.
Apple reported earnings after the bell, as Tucker noted, and big thing, so they had a good quarter. Their sales came in 10% up year over year, $94 billion. So it's always nice when you can sell $1 billion worth of stuff a day.
Yeah.
We should all be so lucky.
Yeah.
They indicated, I'll quote here, Apple's financial chief, Kevin Parekh, said in an interview that the company saw some, quote, obvious signs of pull-ahead demand related to tariffs earlier in the quarter and attributed about 1/6 of iPhone sales growth to such purchases and the rest due to very strong upgrade performance in general. Now, the bright spot was a 4% increase in China sales after declines in recent years. So this did have shares up about 3% after hours. They can't hold the gains. They're down 1.9%, right, which is more than the broad S&P 500 today. So this continues a trend that we've been seeing that honestly kind of reminiscent of what we saw in Q1 earnings, where companies are reporting good earnings and they're just getting bopped on the head because good isn't good enough. You got to do what Meta did and blow people away with what's, what you've done or what's coming next. And Apple doesn't give guidance anymore, so they can't blow people away with what's coming next.
Yeah, there was nothing new there. Right?
No.
The sales beat expectations, but yeah, some of it was tariff related, people pulling purchases forward, and you have no new announcements about artificial intelligence. So I don't think that this market cares about you in that case.
I want to talk about this piece from the Bloomberg here.
Yeah.
It's titled, Here's a Better Plan for Retirement Than Social Security. And it's by someone by the name of Nir Kassar. And I'll quote here, what he said. He said, 2 years ago, I proposed the federal government put away $10,000 for each baby born in the U.S. in a tax-free account invested in U.S. stocks and accessible only at retirement. If it grows 7.5% a year after inflation, which is roughly what the S&P 500 index has done over the last 100 years, it'll blossom into a roughly $1.8 million in today's dollars when that baby turns 70.
That's all true, by the way. Math works.
I'm actually not. I did the math on my own, and I got $1.5 million, but I'm not going to let $300,000
Yeah, I guess it depends when you're compounding. Fair enough.
I'm compounding, whatever it is. Anyways, it's a richer retirement than Social Security can provide. By that math, a $1.8 million portfolio using the 4% rule will generate $72,000 of income, triple what the average retiree receives from Social Security. So, this is where we become very problematic in the math. And if you're listening, sorry for the math on the radio, but here's the deal. You can't compare $72,000
70 years from now, because that's the math that he's doing.
You can't compare that to what someone is earning today from Social Security. Now,
why
especially
not? We have this thing that has existed since the beginning of humanity for most societies called inflation.
Now, he's saying that if the investment grows 7.5% after inflation, it'll be $1.8 million in today's dollars. So I guess he's trying to adjust for it, but he's assuming that you see the exact same return and that inflation doesn't eat into any of it. It doesn't make sense to me. I'm not getting there.
It really... Here's the dangerous part is I think we're going to see a lot of these types of proposals out there for how we can fix Social Security really cheaply. And the problem that I'm seeing here is let's assume that you take the current average Social Security benefit, which he did here. It's $24,000-ish. And you need to compare that to what it would be with some modest COLAs over the next 70 years. We're talking about a Social Security benefit 70 years from now that's $132,000. So that $10,000 investment that you made is not, I don't think, quite getting us to where we need to be to fix Social Security. I bring this up because I think we're going to get hammered with these ideas that don't.
And what if the growth isn't there?
Right. I mean, what if the stock market
before
growth
we even
isn't
get
there?
to what if the growth isn't there because of demographics or why do we assume that the last 100 years is what the U.S. is going to do for the next 100?
I think there could be an intelligent debate to be had about how the Social Security's trust funds are invested. There are plenty of countries that do not do what we do with the Social Security Trust Fund. They go and invest funds elsewhere and see their trust funds grow faster. That's a debate that I'm on board with having. This funky math that doesn't actually work, it's just irresponsible, quite honestly, because it's going to convince people that, oh yeah, we can fix Social Security by this quick fix of just tossing $10,000 into an account, and it actually just wouldn't do it.
And just as an example, let's say that this grows by 6.5% instead of 7%. You say, okay, that's a measly 1% a year. What's the difference? If you add it up by the end, again, because you're compounding for 70 years, the amount that you earn over that time is cut in half. It doesn't go down by 1%. Right. It gets cut in half. If instead of earning 6.5%, you earn 5.5%, the amount that you earn doesn't just get cut in half, it gets cut in a quarter.
So, again, I think all of this to be said, Americans don't want their Social Security to be replaced by some privatized 401k.
Maybe they do. I'm not here to speak for what every American wants. I don't know what Americans want for Social Security. I'm just telling you that the math on this assumes things that I don't think you can assume to be true over 70 years.
Yeah, I would tend to agree. I bring this piece up because I think people are pretty aware of the state of the Social Security Trust Fund. Certainly if they listen to this show, they are aware of that Social Security Trust Fund and its soon-to-be demise. If you are wondering about how that affects you, how to model out the potential impact of Social Security, I personally don't think Social Security is going to get cut the way that the laws state today, but I do think it's going to be changed in some way, shape, or form. And so if you're on the cusp of retirement and planning on that benefit or already receiving it and potentially planning out for the future, it's important to consider where that Social Security benefit could land. Give us a call at 800-393-4001 and build a plan that works for your financial future. Again, that's the Armstrong Advisory Group at 800-393-4001.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Mike, there's a piece of the New York Times I want to touch on quickly. AI researchers are negotiating $250 million pay packages just like NBA stars. And
good, get paid.
Right, like I don't see this. If you're like the one person in the world who can do what you do, go get it. The risk that these companies have, hey, once you've paid someone $250 million, what if they decide they don't like working for you anymore?
Yeah, that's a bit.
You know, like once you got the money, what if you just like
I don't even want to
buy
work
Zuck
anymore.
You know, like I really don't. You know, what if you just like I don't enjoy doing this, and you
hope-
put all your eggs in that basket?
Chuck, I just would hope that Meta's lawyers are better at negotiating pay packages and structuring pay agreements to account for somebody just saying, "Hey, I got my $250. I'll see you later."
Even if it's not $250, I mean, Mike, like what's a life-changing amount of money for a person?
For the average person,
I mean, look, if
$1
you're in AI, you probably already have you've probably already gotten paid pretty well.
Yeah.
But honestly, let's say that out of that $250 million, you can keep 20. Okay, bye. Sorry, Mark, I'm out.
Yeah, I don't know.
You know, like you don't have to keep all of it. What if you only keep 10% of it? It's fine. You can do just fine on $20 million.
Yes, you can.
You know, you could have boats and private jet trips and stuff like that. It's like, so I don't know. This seems risky because at a certain point, if it's all about the money, then once you have the money, why do you need to stay there?
Because of American greed, Chuck. There is no dollar amount that is enough. It's the whole way that our problems with money in this country come to exist is the guy that goes from making 50 to 100 suddenly feels like everybody that makes 250.
It's not just money, Michael. I still remember in Cool Runnings, you know, DeReese is talking to John Candy, and he goes, "How will I know if I have enough? If I'm enough?" And John Candy goes, "When you cross that line, you'll know." And apparently, none of us know when we've got enough.
Correct.
Let's take a quick break, and when we come back, when we come back, Paul LaMonica from Barron's joins us. We're talking Figma. Is it just a Figma of your imagination? Who knows? We'll discuss when we return.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network. Cushing and Dolan know that no two families are alike, and neither are their estate plans. If you want a stress-free retirement, early planning is key. And for many, trusts are the tool of choice to protect assets and minimize taxes. But here's the challenge. There are dozens of trusts out there, revocable, irrevocable, and each comes with different rules and tax implications. From family trusts to special needs trusts, creditor protection trust to charitable trusts, each serves a different purpose. Knowing which one fits your situation can make all the difference in your plan. That's why Cushing & Dolan put together a brand new guide demystifying the top 7 estate planning trusts. It breaks down the most common trust options so you can decide what's right for your family and your future. Call 866-848-5699 right now and ask for your free copy or request it online at LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. New Englanders love the Caribbean, and now there's a Caribbean travel channel available for you to learn all about Caribbean culture while you're planning your next trip to your favorite island. The TravelShareIt.com marketplace is loaded with information about the arts, festivals, food, and music throughout the Caribbean, and is an interactive website featuring daily travel deals to any island of your choice. Book your next Caribbean vacation on the most comprehensive travel channel for the islands, TravelShareIt.com. That's TravelShareIt.com.
This is Michael Valila, Adjutant of the Disabled American Veterans Department of Massachusetts. We focus on the people returning from service, not their specific illness or injury. Our number one goal is to make sure our veterans have the necessary services they need, be it physical, emotional, or financial, so that their transition can be seamless. You can help our great American heroes as well by making a donation today by visiting dav5k.boston. That's dav5k.boston.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. When it comes to legacy planning, having a will is important, but it may not be enough. A will only covers probate assets, and the probate process can be slow, public, and expensive. That's where trusts come in. Trusts can help you avoid probate, keep your wishes private, and control how and when your assets are distributed. Whether you're looking to support family, minimize taxes, or prepare for the unexpected, a well-designed plan can make a meaningful difference. Our new free guide, Leaving a Lasting Legacy, covers wills, trusts, and other strategies to help you build a strong retirement plan. Take the first step towards clarity by calling 800-393-4001 right now and asking for your free guide today. That number again is 800-393-4001 or request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you over the age of 50? Want peace of mind and financial security for your family? Here's an important message to you from Senior Care USA. The average funeral now costs over $10,000. That leaves your loved ones the burden of paying your debts and funeral costs. Our plans start as low as $1 per day and will pay your family up to $30,000 to help pay for your funeral and other expenses. There are no medical exams. Your rates will never increase, and your plan cannot be canceled, regardless of your medical conditions, as long as you make your premium payments. Get up to $30,000 in final expense insurance. Call now for free information. Just answer a few simple questions and get approved right over the phone in just a few minutes. Call right now.
Call 800-378-3818. 800-378-3818. 800-378-3818. That's 800-378-3818.
The Financial Exchange is now available every day from 11 to noon on SiriusXM's Business Radio Channel 132. Stay informed about the latest from Wall Street, fiscal policy, and breaking business news every day. The Financial Exchange is live on SiriusXM's Business Radio Channel 132. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
All right, Paul LaMonica from Barron's joins us now, and we're talking Figma with Paul. Paul, how you doing?
I'm good, thanks. How you guys doing?
We're doing well. What is Figma? What do they do?
Yes. Yep. Figma is a design software company. So if you look at websites and apps like Google Maps, Uber, JetBlue, Duolingo, Airbnb, these are some of the companies that Figma says are customers that they work with to help design, their the look and feel of some of their sites. They compete with Adobe, which interestingly enough tried to buy Figma a few years ago. There was a deal for $20 billion, but there were regulatory concerns in the UK and Europe. So Adobe and Figma had to walk away from the deal. Figma recommitted itself to being an independent private company, and now they're public. And would you look at what the stock is doing? It's trading, more than 3 times that $20 billion valuation that Adobe offered for it just a few years ago.
So how is what's the deal with this company and how heavily it's valued? Because if I'm looking at this correctly,
yep,
it's got a market cap of almost $60 billion. They have yet to do $1 billion in revenue in a year. So is this company growing like a weed? Like what's the deal here?
Yeah, they are growing rapidly. Revenue growth is north of 45%. So obviously very solid sales growth. But you're right, they still haven't reached that critical mass of $1 billion in revenue. And they also have been inconsistent with regards to profitability. They lost money last year. 2023, they made a profit, but that was only because Adobe had to pay them $1 billion merger termination fee. You back that out, and they lost money. The good news is that profits were there this first quarter. They were profitable in the first quarter, and revenue growth continues very aggressively. So I think there are hopes that they're on that proverbial path to consistent profitability. But that's something I think investors are going to need to see to justify this type of valuation. Figma, it had a 250% pop yesterday. It's up again today a little bit on a down day for the market. So there's clearly a lot of enthusiasm.
How do people think, or why would people think that Figma has staying power in a world where technology seems to be evolving so quickly with AI and what it can do?
Yeah, it's a great question. I mean, Figma has talked about integrating AI into their own software offerings. I think it remains to be seen whether or not they will face more competition from generative AI and cheaper solutions. There are plenty of other companies out there. There's another private company called Canva that competes with them that could potentially be an IPO candidate as well. And then you shouldn't totally discount Adobe either, which is trying to step up its AI offerings. And so far, I think the market has been skeptical of Adobe. That stock is down this year. It makes you wonder what they would be doing if they had actually been able to buy Figma and had that as part of their business for the past year and a half. But, that obviously wasn't the case. So, there is a lot of optimism about IPOs. Once again, we've seen it with Circle in the stablecoin business. We saw it with CoreWeave, even though they stumbled when they first went public in March, because it was right around Liberation Day, but they've roared back since then. That stock has more than doubled. So, the good news is that I think the stories are good for many of these companies and the growth is there. But again, it all comes down to valuation and profitability. I think a lot of these IPOs are stretched and some of them aren't yet profitable, need to start posting consistent earnings to justify these valuations.
Very good. Paul, appreciate you joining us today. Have a fantastic weekend, and we'll catch up with you soon.
Great. Thanks a lot, guys.
Paul LaMonica from Barron's talking about Figma. Mike, what do you have that we haven't caught up with yet?
A listener question, quote, does the Fed have access to these numbers before they are released? So we've talked about a lot of numbers today. So I'm guessing, though, what we're talking about are economic data releases like jobs numbers and things like that. And the answer is, I believe, with many of these statistics, but not all, the Federal Reserve, key members of the White House, and a few other central people do receive these releases about a day before the general public. Not a week before, but 1 day prior to the general public. The Federal Reserve chair, for example, probably had access to the jobs numbers yesterday afternoon, but not prior to the Federal Reserve's meeting where they discussed interest rate policy.
Yeah, I don't know the specifics on exactly what reports they receive at exactly what time, but I do believe they do get a little bit of advance notice on these. Markets remain broadly in sell-off mode. The Dow's off about 1.1%, S&P off 1.3%, NASDAQ off 1.8%. We're done for the day, done for the week. It was a busy one, but we got the whole weekend to rest up. Hope you all get some time to enjoy, and then we're back at it on Monday.